So I'm going to attempt to do daily definition, like a video series based around financial definitions that I think would be helpful to others, helpful to me, that I've come across in reading. So I'm trying to get more financially literate and well versed on all things personal finance, money, credit. So I found that I have to stop reading, stop what I'm doing, and look things up. So I figured, why not share what I've learned with you guys. So this is the first video in the series. I'm gonna try to do a theme. So this theme is, I guess, credit. So credit definitions that you may come across that you don't actually know what they mean. So, okay, I'm going to stop rambling. The first one is, and I wrote it down in a notebook. So the first one is installment loan. So what is an installment loan? I've definitely heard the term before. I'm sure all of you guys have as well. But the definition of an installment loan is one in which you borrowed a certain amount of money and you have to pay it back with interest, and you're going to pay it back within a series of equal monthly payments that you and the lender agreed upon. So an example of an installment loan could be your car note, or your mortgage. So these payments are the same every single month, and you pay them back to the lender. The next term is revolving account. So definitely have heard that term, but wasn't actually sure what it meant. So what it means is it's an account where you do not have to pay the full balance back every month. So say you were extended a line of credit for $5,000. You spent $1,500 in that month of the $5,000. You don't have to pay that $1,500 back though, in full the next month. So if you can pay the minimum payment, if you want, you can pay above that. You can pay the full amount, but you don't have to pay the full amount on a revolving account. So what happens is the amount that you don't pay rolls over or revolves into the next month, and interest is added on it, and then you get your new balance. So a revolving account is like a credit card, and you don't have to pay the full amount that you spent back every single month. You can carry a balance. The next definition is a minimum payment. So we've definitely all heard of a minimum payment. It's the minimum amount that you either get your statement in the mail, or you check it online, and it tells you what your minimum payment is. So it's usually, it depends on what it is, but it's usually not very much. And how they calculate it is, I think they take all the interest and fees for that month and add 1% of the principal, and that is your minimum payment for the month. So a minimum payment generally is not something you want to pay if you don't have to. If you can pay more, you should definitely pay more. Actually, the government made companies increase the minimum payment amount because they used to make you pay even less than what they do now. So they're winning by having you pay the minimum payment. You're paying way more than you actually need to, than what you actually borrowed, what you actually spent when you're making only the minimum payment. and they know that. So that's why, like, it's, it's usually bold and nice and big on your statement. It's a number that's really manageable. So and they try to make it really enticing for you, but try not to make the minimum payment. So one of the words I used in the definition for minimum payment was, I think I said principal. So the principal is, and I'm just learning these things myself, so it's good for me to like jog my memory as well. So the principal is the amount that you currently owe your creditor or the lender. So yeah, that's what the principal is. So sometimes you make payments and you're only touching the interest because so much interest has like accrued. You're not even touching the principal, like what you actually owe them. You're just paying back all of the interest. So yeah, the principal is just the amount that you owe the creditor less interest. Okay, let me look at my little sheet. Interest. What is interest? Interest is the amount of money that you pay on top of the money that you borrowed. So pretty simple definition. And then another way to look at it is it's the money you pay in order to delay the repayment of a debt. So borrowing isn't free. What is credit? People say, oh, I have good credit or I have bad credit. So credit is basically, it's like a 3-digit number, that's your credit score. But credit is, where companies or like lenders assess whether they think you're a risk or how worthy you are to lend money to. So that's the definition of credit. Sorry, that's a complete lie. Okay. Credit is the ability of a person to get goods and or services and before payment. So yeah, that's what credit is. So some people can have good credit. They have good ability. They have a very high probability, a good ability to get goods and services before payment is due. People who don't have good credit or who have bad credit, they are going to have a less of an ability, less of a chance to be able to get any goods and services before payment is due because banks, institutions, lenders don't find them, they find them to be more of a risk. APR, annual percentage rate. That is the real cost of borrowing money. So it's the interest rate charged on your credit card balance every single month. So unless you have you've heard of zero APR, unless you have that going for you, whoever you borrowed from is going to be charging you an APR, annual percentage rate every single month on top of what you borrowed. So you have to factor that in. So say, you're excited, you got approved for a store card or something, and the amount was $1,000. Then you should read. Nobody really read. I don't read it, and they probably bank on the fact that nobody really reads those terms and conditions paperwork that you get when you are approved for a card. But in there, it might say something like 22% or something APR. That's the rate. So if you don't pay off that card every month in full, they're going to charge 22% on top of your balance. So that's what they like to sneak in there, and that's the real cost of borrowing that money from them. Credit score. So your credit score is a 3-digit number that basically tells people whether you're like a credit risk, and it tells people about your credit worthiness. So you can have, mostly people define it as you have good credit or you have bad credit. So the higher the number, people say you have good credit, and the lower the number, people say you have bad credit. And your credit score is based off of your credit report, and your credit report is basically your credit history. So as soon as you started getting credit in your name, it's been tracked and filed and recorded and all of that good stuff, and that is ultimately how that number is generated for you. Utilization ratio. So I just went on, I think it's annualcreditreport.com to get my FICO score, and you can get that. The 3 different bureaus are on that website, and you can get your report from them once a year, once every 12 months. You don't have to get all 3 at once. I just got TransUnion for right now. And I've also, I saw, they talked about it on annualcreditreport.com, and then also when I was on mint.com, another website where you can look at like your credit history and your finances and all that good stuff. It talked about credit utilization ratio, and mine was actually in a good place. So what that simply means is the amount that I borrowed versus the amount that is being used up. That number is low. So the lower the number, the better. So companies, lenders like seeing that, okay, we offered this girl or this person has access to a lot of credit, but they're not using it. So it's good, I guess, to, have these high credit limits, and people extend you a lot of money to borrow, but the fact that you don't borrow it, and that you let it sit there and aren't using it, is a good thing in their eyes. So that's the utilization ratio, and you'll improve your credit score if that number is low. Okay. A variable interest rate. Again, a term I've heard of, but didn't really care to look into it in the past. But a variable interest rate is kind of just like what it sounds like. So it's an interest rate that can change, and that's based on an interest rate set by the Federal Reserve, called an index. Like, that's what they call their interest rate. So like your credit card company, if you did take the time to read that paperwork they gave you, and it says like variable APR, variable percentage rate, it'll typically say something in there like index plus maybe 10.99%. So index is that federal interest rate. So that, with a quick Google, you can find out what that is at any time, or if you're somebody who like watches the news a lot, or reads like the Wall Street Journal or whatnot, I don't know, then you just might know that number offhand. But so say right now the federal interest rate is 4%, and then that paperwork you have says it's the federal interest rate or the index plus 10.99%. That means you're going to get charged 14.99% interest on top of the balance that you're carrying on your credit card. So you take the 10.99, that's fixed. Your credit card is going to be charging you that, and then the variable portion is what the Federal Reserve does with the interest rates. So it can fluctuate. So just something to keep in mind if you have a variable percentage credit card. Just be aware of that because if it goes up very high, that's not good. Vantage score. So I recently found out, and recently means like today, that like I was a fan of Credit Karma. Like that's like a name that's like really widely used. I didn't know there was a difference in the scores that you get from like a Credit Karma versus other places. So, and other places like annual credit, it could be like annualcreditreport.com or Discover. I found out that Discover, like the Discover card, you don't even have to be a customer of theirs, and you can get your FICO score from them. And so anyway, the Vantage score is a competitor to the FICO score. So it was launched to compete with the FICO score because the FICO score is the score that pretty much every lender looks at. Like they don't really care about that Vantage score. So most of the free sites out there are giving you your Vantage score. And yes, it's good to know. It's like a good like barometer. You can get a pretty, it's typically not the same as the FICO score, which is the problem. Because when you go into like you go into like the bank and ask for like a loan, and they're clacking whatever on their computers, they're pulling up the FICO score, and you might have just you might have been at home the night before and like looked up Credit Karma and seen your credit score and been like, oh, I'm definitely gonna like get this loan like at a great interest rate, but typically the Vantage score looks better than your actual FICO score, and the Vantage score is not what these lenders and people are using. So definitely get your FICO score if you're trying to get like a loan or credit or something, because that's what they're looking at. And just so you're in a better place and you guys like are on the same playing field and you can know what they're looking at, and it can help you like with negotiating or just knowing. So just so you guys both know that same number and you're not like thinking of some other number when you go in to like talk to them. So yeah, the Vantage score is an alternative, I guess, to the FICO score. It's not your FICO score. It's not the one that all the lenders are looking at, but it'll give you a good gauge. You can pretty much tell from that number, is my credit good? Is my credit bad? Like what are there things I need to work on? Because it's not drastically different, but it's different. And then, on the other hand, your FICO score is the score that all of the companies, the lenders, the banks are looking at when they are deciding whether or not to approve you for a loan, to give you credit. So they're looking at FICO, the FICO score. It's also a 3-digit number that determines if you're a risk, if you're worthy, what rates they're going to give you. So yeah, that is the one that you should try to definitely obtain. If you're going to meet with anybody, or if you're trying to, get a loan, get credit. The free ones are fine. Like the Vantage one is fine, just so you kind of have a rough idea. But the FICO one is the one that you like want to go and like play ball with. So yeah, those are the definitions I have for you guys today. Maybe that was like, I don't know, 10 to 12. So they're probably going to be in that range, and they're going to be themed, like I said. So today, and I don't think I'll do this daily actually, because it's a lot. We'll see. Maybe like once a week or so. So I might have to think of a different name than daily definitions. But yeah, so this hopefully helped you out and helped to define some words that are thrown around all the time and that you definitely have heard of, words and terms that you've heard of. But now this hopefully gives you some more like a background about what they mean and some context. So I hope it helped. Definitely let me know if you have any questions about anything that I went over.